Dividend yield is exciting. When you decide you're going to go into the stock market with the idea that you're going to be a dividend investor, you want to start accumulating yield because it's exciting. And I don't blame anyone for being excited by that. My dad, who's an accountant, he was just like, man, Colby, you don't know how to fix anything. You are not a handy person at all. And, he's like, you don't have this massive pile of money to work with right now. Why don't you just invest in stocks? Think about the three little pigs, right? You've got your house of straw. That's your high yield trash that's floating around out there. Put it together really quickly, but if you ask me, I think it's going to fall apart after a while. Like you say, I'm not trying to get rich by Tuesday. I'm trying to get rich. Age is the most important metric that you've got to look at as a dividend growth stock investor, and you've got to prioritize dividend growth. Patience, number one, but it's also peace of mind. I don't think that timing the market is a good strategy when you're investing in the S&P 500. So why would it be a sound strategy to be in a position to time the market when you are selling the S&P 500 to live off of?
Investors, welcome back to another go-round of Masters of the Market. I'm excited this week. We have Colby Craig joining us from the YouTube channel, the DGI Crab, talking all about dividend investing. Now, he went from Dave Ramsey's baby steps to just south there of $500,000. So we're about to talk about that all. Colby, I want to first and foremost welcome you to Masters of the Market. You've been a viewer, but now you are on as a guest. So I'm excited to have you. And I just want to pass the first question right over to you. Ask you about your story and how exactly you got to where you are today.
Thanks so much for having me on, Ari. I've been a fan of yours since the Blue Lion Finance days, and really enjoyed watching you and your channel grow, and I'm hopefully do the same for mine. My story is not super exciting. Like you said, I was a Dave Ramsey acolyte for quite a few years, and in some ways still am. I'm not a proponent of debt or of leverage. I started getting serious about investing in the stock market back in 2018. I had wanted to start investing before then, but I did have student loan debt. I had car debt. I had a little bit of credit card debt, you name it. And I knew I wanted to get that cleaned up because I did not want to put the pressure on myself to somehow perform better in the market as a novice investor versus the interest rate that I was paying on all of those combined debts. So once I got all of that mess cleaned up in 2018, I started to get serious about investing. Initially, it was mostly just retirement funds, and anything I was putting in my brokerage was largely going into the S&P 500. As I was sort of in research mode, I wasn't sure what type of investor I wanted to be. I did have a friend, or do still have a friend, who's been very successful with real estate investing, and he's more of the Robert Kiyosaki rich dad, poor dad mentality of utilizing leverage in order to purchase real estate. He's been very successful in that, but I'm just a lot more risk averse, I suppose. So in 2019, I almost went down that path, and I'd even picked out an investment property that I thought that looked like seemed to be a pretty good deal. My friend was sort of helping me vet those. Before I made any major decision on that, I decided I would consult with my dad, who's an accountant, good with money, to get his 2 cents on it to see if he thought I was making the right choice. And he was just like, man, Colby, you don't know how to fix anything. You are not a handy person at all. And, he's like, you don't have this massive pile of money to work with right now. Why don't you just invest in stocks? And he didn't really tell me what kind of stocks to invest in or what particular strategy to go about doing. But I thought, well, that's probably sound advice. I didn't feel particularly confident about going into real estate. At that point, I really started looking at investing, and from there I started looking at REITs, which got me interested in the concept of dividends. And then by 2020, when the COVID crisis hit, even though I still wasn't quite at the point where I felt like I knew exactly how to take advantage of those buying opportunities, I knew that this was probably a once-in-a-generation buying opportunity to get into the market. I just, for whatever reason, I don't ask me why, I just wasn't super concerned about the pandemic causing long-lasting stock market downturns. I wasn't sure when, of course, the market was going to turn back up again, but I felt pretty confident that it was just going to be a temporary problem that we'd look back on as just a blip on the radar, just a bad year. And I certainly got into dividend investing by that point in time. I knew I wanted to focus on blue chip companies, but by the time we got about to the end of 2021, I'd really sort of nailed down my personal investing strategy. And where I landed on that was the most important metric that a dividend growth stock investor should be taking into consideration is their own age and timeline that they have toward retirement.
Well, we're certainly happy to have you in the dividend investor community, and the spaces here now on YouTube. I think we need more YouTubers sharing about really the treasures of dividend investing, how simple it is, and anyone can start, gain that momentum. And as we'll get to, I mean, in your portfolio, you've come a long way. Before we even start to talk about investing, I want to talk a little bit about Dave Ramsey's baby steps, ask you about what those baby steps are all about, and what you think some of the most important moves investors should even be making before we approach the stock market.
Sure. Well, for anyone that's not familiar with Dave's strategy, he has 6 baby steps. Step 1, save $1,000 for emergencies. Step 2, clear out all consumer debt, everything that's not a mortgage. Step 3, get a fully funded emergency fund in place, 3 to 6 months worth of expenses. And then steps 4, 5, and 6 are done concurrently. Step 4, 15% of your income goes into retirement funds, so 401ks, Roth IRAs. And step 5, putting some money aside for your kids' college fund, if you have kids, or if you want to have a college fund for them. And then step 6 is paying off that mortgage and becoming completely debt-free. For me, I think that this is, from a financial strategy standpoint of everything that I've seen out there, this is the only one that I personally would say is 100% guaranteed to work. Now, a big reason for that is it's not a risky strategy. You're not leveraging yourself. You're not taking any major risks. It's all pretty vanilla. It's about hard work and financial discipline and having a plan in place. And I think where a lot of people, once they've gotten some financial education, will sort of start to veer away from what Dave does in that step 4, 5, and 6 area. A lot of people struggle with the idea of paying off their home, especially if they have a low interest rate, because if you've got, say, a 3-ish% interest rate on your mortgage, and then you look at something like the S&P 500 that averages 11-ish% a year in returns, you just kind of run the math on that and you realize there's potentially an 8% spread that you're missing out on. I fall a little bit under that camp. The only debt that I currently carry is my own personal mortgage. I've got about $80,000 left to go on that, and I'm really looking forward to getting that cleared off. I know I probably could make better returns in the market if I was 100% down that path, but I am still throwing extra money every single month on my mortgage despite the low interest rate, because I just want to get that cleared off and have less month-to-month issues or expenses to worry about. That's going to give me even more money to invest into my strategy. And then heck, if anything goes wrong with that strategy, I don't have that pressure of, gosh, the stock market just crashed. My investments all got cut in half. What am I going to do? Well, if I don't have a bunch of silly debt lying around, I'm still gainfully employed, then hey, all I have to do at that point is just hunker down even harder, put even more money into the market, and see bigger returns. So I'm not a proponent of investing into anything that's risky, anything that is, small cap that I don't really know a lot about, or super high yield stuff that's, in my opinion, too good to be true. My strategy is all about investing in stable blue chip companies and ETFs where the dividends are increasing year in and year out. So I may not be quite as conservative as Dave Ramsey, but I'm certainly still at least got one foot in in his camp as far as that goes. Clean out your consumer debt. You're probably not going to get a better return in the market than you're going to get by paying off your car, paying off your credit cards. Get rid of that stuff so you have more money to invest.
Look, to Dave's credit, I think, the masses of, I think, Dave Ramsey's, I'll say graduates, if you will, can attest to it is he has a very simple, straightforward approach that just works. And I'm seeing it now firsthand, with you and your story. And you also mentioned something else as you were speaking, in that it seems to be that you've developed your investor profile and you're investing according to your timeline. How did you come to your investor profile?
I guess in some ways it could be Dave Ramsey inspired, in that what I liked about Dave's approach is it's very systematized. You've got a roadmap, you've got a plan to follow. So I guess part of the credit could go there. And then another major inspiration for me was here on YouTube. There's the Dividend Diplomats, who I know you've had on your show here, Masters of the Markets, Bert and Lanny. They sort of gave me permission to focus on some key metrics that were important to me and to trust in a consistent strategy. Because one of the problems that I think investors can run into when they're watching all these different YouTube shows, they're getting great advice from the overwhelming majority of them. And I ran into this problem myself in 2020 and early 2021, where you're watching these different shows, you're watching Bert and Lanny, and they're investing in something, and the metrics look great. And then you're watching Ari, and Ari's investing in something, and he's got great reasons for that. And then you see Ryan Williams or Russ Knopf or Dividend Bowl, or all these great channels that are putting excellent information out there, and all of you've got really high batting averages. But the trouble you might run into is all of a sudden, if you're kind of following along with all of these, you turn around and you're like, oh my God, I've got just all these different positions. They're all small, and you kind of lose track sometimes of why you invested in certain things to begin with. It can almost make you more likely to turn into a trader type of mentality, where you say, well, I've only got 3 shares of this and 5 shares of that, and they're up, and I was excited about those 18 months ago, so I'm going to cash out of those and move that over here. And it just got to be where there wasn't a consistent approach for me. So I thought, well, I want to be systematized in my own personal approach as well. So what I look for primarily is a history of a company growing their dividends, large market cap with a wide moat, so I can sleep well at night owning those companies. So your boring stuff, right? Your Procter and Gamble's, your Microsoft's, your Johnson and Johnson's, that kind of stuff. But very quickly realized that depending on what your investor profile is, what your time horizon is, it makes more sense to invest in Microsoft or Visa or Parker Hannifin if you're in your younger years. And if your goal is to live off of dividends, if that's the finish line, those are the kind of things that you want in your younger years. Because look, if you run the numbers on a company like, let's take Parker Hannifin, for example, Dividend King, they typically have a very low starting yield in the 1% range, very rapid growth rate in the 10 to 15% range. Well, if I'm 57 and I'm piling up a bunch of money in Parker Hannifin with the goal of living off of the dividends, well, I'm not going to get the benefit of that rapid growth, because, not to be morbid, but I've only got a certain amount of time left for those dividends to compound. And on the other end of the spectrum, something like Verizon, for example, boring stock, right? Yields 6-7%. It grows the dividend about 2% a year, just about like clockwork. That's not really going to compound even with dividends reinvested. That's not going to compound like Parker Hannifin or Visa. So if you're 24, 25 and you're loading up on all this Verizon stock because you're excited about getting the yield right now, you're going to miss out on a crazy amount of dividend snowball effect by just getting 2% year-over-year growth on that. Whereas if you're 57, that's exactly what you want. Just something that's stable, high yield. It's going to give you a little bit of growth to keep up with inflation. So then I thought, well, I want to take the best stocks that I can find, break them down into separate tiers or age ranges, because that's going to provide me with a smaller amount of stocks to pay attention to. So I'm not going to have the problem of owning 50, 60, 70 different stocks that are all over the place. I can just zero in on 10, 12, 15, build up those positions when they look like they're trading cheap, and do so in a way that's age appropriate. Because if you're sitting there age 18 to age 30 and you build up a portfolio of this high growth stuff, By the time you hit age 30, maybe you've got a couple $1,000s worth of dividends coming in each and every year, which doesn't seem very exciting. But if your growth rate's 13, 14% cumulatively, that $2,000 is going to double every 5 years, even if you're not investing in those stocks anymore. By the time you get into your 50s, that's some serious money for not a lot of money invested initially. So that was where the genesis of the channel came from, because I didn't feel like that was something that a lot of the channels were putting enough emphasis on. Parker Hannifin and Verizon are both excellent stocks, but it just depends on how old you are and what your time horizon is for if they're excellent for you.
I want to double down on this because I often actually talk about this myself. It's so important to recognize your investor profile and then act on it by investing accordingly. Why is it, do you think, that the massive investors are not, discovering their investor profile, or at least not taking the appropriate investment actions?
I think there's two parts of the problem when it comes to young investors. Part one is dividend yield is exciting. So when you decide you're going to go into the stock market with the idea that you're going to be a dividend investor, you want to start accumulating yield because it's exciting. And I don't blame anyone for being excited by that. You start seeing passive income coming in, and you want to just start adding more and more and more. And the second part of the problem is you've got to do math. And even for an investor, sometimes just looking at the math can be kind of boring. I look at it like this. You've got to keep the rule of 72 in mind, which just is that your stocks are going to, your yield is going to grow by a certain percentage every year. And by factoring in this rule of 72, you can get a good idea of what that's going to look like. So if I have, let's say that I invest in Parker Hannifin with $1,000 and Verizon with $1,000 on the same day. The Parker Hannifin, that's probably going to get me, about $10 to $12 worth of forward dividend income. Whereas if I do that with Verizon, I'm going to be getting $60 to $70 worth of forward dividend income. So for a young investor, they look at that and they say, I'm getting 5 times more money on this Verizon right now. I'm reinvesting all of my dividends. Those are getting me that high yield. When those reinvest, why in the world would I buy something that has a 1% yield right now? And the reason for it being is that 13, 14% annual dividend growth is going to double your yield every 5 to 6 years. And if you're 20 or 21 or 22, you haven't even been around that long yet. It's harder to visualize, where those investments are going to be in 5, 10, 15 years. So having that long-term approach when you can be buying yield right now in the short term is sometimes a tough thing to sell. But if you just break down that math and really look at it, the Parker Hannifin 20 years later is going to be yielding you so much more money than the Verizon is 20 years later. And when you get to that point where you're not reinvesting your dividends anymore, hey, congratulations, you've reached financial freedom. You are retired. Do you want to have a pile of stocks that are growing that yield 10% plus every single year? So you're getting a 10% raise every year without reinvesting dividends? Or do you want the 2% raise with the high yield, low growth stuff? Well, like we've seen in the last couple of years, there's years where inflation gets really, really wild and out of control. If there's 9% inflation and your dividend yield's growing 2%, that math doesn't work out so well either. Age is the most important metric that you've got to look at as a dividend growth stock investor, and you've got to prioritize dividend growth rate over starting yield when you are young. So that's what I preach week in and week out. And I believe I've picked a nice group of stocks for each and every tier along the way. I started out with 250 plus dividend growth stocks and just kind of started narrowing them down, putting them in their respective buckets. Pretty confident I've got a group of 60 in total that are really, really high quality. I don't anticipate any dividend cuts coming out of any of them anytime soon. And again, if you're young, you've got that bucket of low starting yield but super high growth. And if you could stick to that for a while, you're going to see that those dividend increases increase your income by more than just new fresh money that you're putting in there after a while. You just have to break it down and really look at it with a long time horizon. And that's tough. That's tough to do the younger that you are.
I want to say you're really in the business of selling patience.
Yeah.
Product to sell.
Yeah, it really is. But think about the three little pigs, right? You know, you've got your house of straw. That's your high yield trash that's floating around out there. I do not like pretty much any of these covered call option things that are floating around out there that have these ridiculously high yields that, in my opinion, are totally unsustainable. That's a house of straw. You could put it together really quickly, but if you ask me, I think it's going to fall apart after a while. Your house of bricks are your blue chip stocks, your blue chip ETFs that, you know, you're not going to get your 50% yield out of that stuff. You're going to have to be patient, build that up through hard work. But if you do it the right way, I mean, hey, like I said, I got 60 stocks on my channel that they focus on. How many of those stocks cut their dividend or opted not to do a dividend increase during 2020? Zero. How many of them did the same thing in the financial crisis back in 2008, 2009? I think with the exception of JP Morgan, which I believe didn't even legally have the option to increase their dividend, all of them increased their dividends through the financial crisis of 2008, 2009. And a lot of them even going back to the dot-com bubble bursting back in 2000, 2001, continued to increase their dividends through all of that. So the idea is yeah, it's patience, number one, but it's also peace of mind, because we're going to have a market crash within the next few years. I don't know when, I don't know what's going to trigger it, but for me, when the market crashes, I'm not worried about dividend cuts with the stocks that I've picked. I'm really not. I'll actually look forward to it. I'll start working overtime. I'll start shoveling even more money in at that point in time if we have another COVID-style crash, because I'll get higher starting yield, which is exciting. And, you know, and I'm not going to be worried about having my dividends get cut in half all of a sudden because of it. Yeah, it's partly patience. That's a big part of it. But peace of mind is another big part of it, because I'm happy when my stocks are up, because that just feels great psychologically. You feel like the smartest person in the world when all your stocks are in the green. And I'm happy when they're down, because that just means I'm going to start acquiring even more yield with my dividend reinvestment and the new income that I'm shoveling in there. It is win-win, baby.
You know, I got to say, the amount of hours I've spent hoping, wishing, and praying for another market downturn like 2020. And it's funny, I look back, I had lump sums of cash, you know, and always in the moment, you're like, you know, could it go a little bit lower? Could it not? So you're doing the dollar cost averaging. I look back, I'm like, I should have just tossed it all in there. Mm-hmm. So hopefully we get something else coming down the pipe. Before we zoom into the 60 stocks that you have, I want to stay at this bird's eye view real quick and just ask you about the S&P 500. I mean, it's as easy as just dollar cost averaging right into the S&P. Why not just do that as opposed to this strategy you have with dividend growth stocks and picking individual stocks?
There's nothing wrong with just dollar cost averaging into the S&P 500. And for a person who doesn't really want to pay attention to individual companies or research different ETFs with different strategies that they employ, you might as well just invest dollar cost average into that S&P 500 week in, week out, because your average rate of return on the S&P 500 is around 11%. But if you're watching this channel, you're probably very interested in being a dividend growth stock investor. Now, I do invest in the S&P 500 each and every week. Absolutely, I do. It is the worst dividend style investment that I make. So if you're going to be a dividend growth stock investor, it's a good idea to have a solid, stable stream of income going in the S&P 500. So you're going to have exposure to excellent stocks that don't pay a dividend. You'll get your exposure to Amazon. You'll get your exposure to Tesla. You'll get your exposure to, I'm going to say Nvidia. I know they pay a dividend, but hardly one. So you won't have to feel like you're missing out on some of those exciting growth companies. And at the same time, you can still be adding stuff in that pays a dividend, hopefully while the price of the individual stock is down. But where I feel like this can be a little bit nerve-wracking for an investor is, let's take the profile of somebody that says, I don't want to learn about all that stuff. I'm going to dollar cost average into the S&P 500. Great. You do that for 20, 30, 40 years. you're going to have an excellent pile of money by the time you hit retirement age. You absolutely will. I guarantee it. However, if that's the only thing you've got in your portfolio and at no point in time you ever did any research on individual companies, alternative ETFs, higher yielding options, etc., you're going to be sitting there in retirement with one holding, the S&P 500. And then at that point, you are in all likelihood selling off little pieces of it every week or every month to cover your living expenses, because your dividend that it pays out every quarter is not substantial. It's probably not going to be enough to cover your expenses unless you've got millions of dollars worth of value in it at that point. Then what happens when 2020 rolls around and you're somebody that's like, oh, I'm in great shape. I'm retired. I've got $900,000 sitting here in the S&P 500. I'm doing great. Oh no, now I've got $500,000 worth of S&P 500 because the market just tanked because of a global crisis. That's really scary. And I don't think that timing the market is a good strategy when you're investing in the S&P 500. So why would it be a sound strategy to be in a position to time the market when you are selling the S&P 500 to live off of? That's sort of where I approach it from, because when I do hit that financial freedom, retire early off of dividends, whatever age I'm at that point in time, I'm hoping that I don't have to sell anything. Then I can just live off of those dividends. And it doesn't matter what the market's doing at that point in time, because I've got income coming in from multiple different places, stocks, ETFs, and yeah, some S&P 500 as well. But I certainly don't want to time my S&P 500 purchases. And when I'm retired, I don't want to have to worry about timing my purchases when the time comes to sell it, because I don't want to be sitting here eating cat food in 2020 because my S&P 500 got cut darn near in half, and I'm terrified that I'm selling too low, if that makes sense.
It absolutely does. It's actually a fascinating point I think you brought up. We often always think about entry, right? So dollar
Right.
cost averaging and entering in, but we rarely talk about, as you shared, the exit strategy of selling off those pieces and timing the market on the sell-off. So I appreciate you bringing that, to all of our attention, and I think it's well worth thinking about. I want to ask you about your dividend stock portfolio specifically now, and I want to get into how many holdings you have. Is it the 60 that you were alluding to earlier? If you could break down the portfolio, give us the value of the portfolio and some of the top stocks that you have in there.
Sure. So my brokerage has, let's see, it has 60. Is that right? 60 holdings, or maybe it's 59. So I own all 60 of the stocks that the channel covers. I do not own any of the REITs or the BDCs in my brokerage. Those I put in my Roth. REITs and BDCs are not qualified dividend income, which just means that the tax advantages on those aren't quite as good as your consumer staples and consumer discretionary and utilities, etc. So when I'm doing REIT or BDC investment, that's going in the Roth. In the brokerage accounts, I've got 56 of those holdings. Let me think about that. I have 2 or 3 REITs. 55, yeah, because I've got some REITs and some BDCs that are in there. So 55 stock holdings, and I have 4 ETFs in the brokerage. VOO for S&P 500. VIG is my primary ETF focus right now for my age range, which is the Vanguard Dividend Appreciation Fund. And I've got some VBR, small cap value. I want some exposure to small caps. And then I have VYMI for my international dividend stock exposure. I don't have any non-US individual stocks at all. I put 5% of my money into VYMI to get that level of exposure. So yeah, it's 60 holdings, and a handful of those are some of the stocks that I narrowed my list down to that I didn't own yet. So I made sure that I made a small purchase into any that I didn't already have, regardless of where they were valued. Just made it easier to track. I wanted to make sure I had my money where my mouth was. And the largest individual stock holdings that I have right now, oh shoot, I don't have the list right in front of me. I've got, I know Waste Management is way up there. I've got quite a bit in Union Pacific, quite a bit in Johnson & Johnson, and quite a bit in Microsoft. Microsoft would be far and away the largest individual stock holding, but before I settled in on my strategy, I was way up on my Microsoft, and I thought, oh, I'm going to sell about half of that. It looks overpriced. I'm going to take some of that money, put it somewhere else in some stuff that looks cheaper, and maybe I'll come back and add more to Microsoft later. And I've just been kicking myself ever since because I've lost out on a ton of gains if I'd have just sat there and held it like I do with stocks now.
Right now, Colby, whereabout are we holding in the portfolio in terms of the total value?
The brokerage is sitting at about 80K right now, and then in the retirement accounts are let's see, because there's the Roth, there's 401k at work, there's about 225 somewhere in there. It goes up and down a little bit, but in total the stock portfolio, including retirement accounts, a little over 300K, and I'm focusing a bit more on building up my brokerage accounts. Still investing into retirement, definitely not slowing down there, but I feel like I've got those up to the point right now where they're going to be in pretty good shape by the time I hit the age where I can actually start utilizing that money. So now my main emphasis is getting that brokerage up to snuff, so to speak. I want to get that up to $250,000 by the time I am 42. So I've got about 14 months to go.
And how long has it taken you thus far? Because you went from Dave Ramsey's baby steps to get to where you are now today. How long about did that take?
I guess we're looking at, so if we're just talking about the brokerage, I mean, we're talking about 4 years. And a lot of that I was just putting like maybe $150 a week into the brokerage and really doing everything that I could to like max out the Roth. I wasn't maxing the 401k, but I was certainly putting quite a bit into that. And really the idea with that was in my earlier investing years, I was still very concerned about just making mistakes, not doing a very good job of picking out individual stocks and companies and everything. And the retirement accounts are largely mutual funds and ETFs, a lot of S&P 500. That's the vast majority of it. I knew that was going to be fine. So, but I've definitely upped the ante as far as what I'm putting into my brokerage over the last 2 years, because I really locked in my strategy for my brokerage account towards the end of 2022. So then early 2023 really started attacking that. So a lot of what's in the brokerage has been a result of just putting more money into it for the last year and a half, 2 years. But there's a fair amount of that that's just growth too. First thing that I bought was S&P 500 with a lump sum. $1,000 went into SCHG because I wanted to have exposure to a lot of that growth and tech stuff without really knowing anything about it. I just knew that I wanted to get that growth, and that's been one of the things that's performed the best. It hasn't gotten me very many dividends, but it's certainly gone way up.
There's so much power behind your story, and I don't know if you've gotten these comments already, but now that you're on YouTube, you most likely will, whereas you're going to get, the commentators saying there's no way this can be done. There's no way, at $150 a week, for even 2, 3, 4, a handful of years that this can be done. And so you're literally at this point now living proof and coming through with experience. The one question I want to ask you, because I always get this one, is, okay, you can go dividend stocks, you can go with the safe blue chip stocks, but let's talk brass tacks here and go growth. I mean, you could probably reduce all of this time down to 2, 3 years and really hit the home runs. So Colby, why not go all growth?
I'm risk averse, I suppose. There's plenty of people out there that have made lots and lots of money by going with growth and by doing swing trades and all of that. Certainly would not tell anyone that they can't make a lot of money that way. You can also make a lot of money playing roulette. And to me, the growth aspect of it is more about timing the market. It has a lot more of an incentive to gamble. And I don't turn my nose up at that. If that's the strategy that you want to go with, then then go with it and learn everything that you can about investing in that way and in those individual companies. And you probably will hit a few home runs. You're also probably going to strike out more often than not as well. For me, I just don't want to constantly be concerned about these different positions because, yeah, I might be celebrating a home run, and at the same time, I'm just totally sweating over a couple of other positions where I've put money into where I did not have the timing all that great, and those positions are crashing. And then if you average all of that stuff out, for a lot of people, you're probably not going to beat the market anyway. You're probably not going to have better than 11% year over year. Some years you might crush 11% and do 50, 60% growth. And then you might have other years where you lose 20, 25% of your money. And then over the course of 10 or 15 years, you look back and you just say, wow, for all that time that I spent and all of that stress that I had, if I just spent dollar cost averaging into the S&P 500, I'd have about the same amount of money. So for me, I want to be able to sleep well at night knowing that the investments that I have made are going to be quality investments the longer that I hold them, the longer that I reinvest my dividends and all of that stuff. Now, if one of my 60 dividend stocks cuts their dividend and I'm wrong about one of them, well, I'm going to sell out of it immediately. I'm going to put that money somewhere else. But that's just one holding out of dozens of holdings. So even if that happens, it's not going to be the end of the world, and I might even get a dividend increase depending on which company it is. If it's one of the lower yielding ones, then I might end up with more dividends at the end of the day by reallocating that money. So for me, it's just all about peace of mind and not trying to get, like you say, I'm not trying to get rich by Tuesday. I'm trying to get rich. I know that by going with this strategy, I'm going to get there. It's kind of going back to that Dave Ramsey versus Robert Kiyosaki. You could probably get rich faster if you're a rich dad, poor dad. But you also have a lot more risk along the way, and you could potentially make some mistakes, do it incorrectly, let's just say, or maybe just have some bad luck, and then it doesn't work out particularly well for you. Or if you do baby steps, you're going to get rich. It just might take a little bit longer, but you will get there.
I want to talk about the approach to discovering dividend stocks or stocks in general for you. I mean, you've amassed now a portfolio of the 60 that you have plus the ETFs,
Right.
but stock specific. And you mentioned some of the fundamental, metrics that you look into, but when you come to the table and you're shopping for some new dividend stocks, where do you look and how do you know which ones to actually target, to continue to research, so on and so forth until you invest into them? What green flags go up for you? What red flags go up for you?
I want a track record, first of all. There's a lot of great stocks out there right now that could be part of that group of 60 because and some of them might even have better metrics than some of the ones that are in that group of 60 that I have, but maybe they don't have the track record just yet. So if I'm looking at a couple of companies in a similar sector, one of them has 30 plus years of dividend increases, and the other one has 7, 8 years. Well, hey, the one that has 7 or 8 years of consecutive dividend increases 20 years from now might actually end up being the better, more profitable one to go with because maybe there's still some more growth on their horizon over the next couple of decades versus the old stable one that's been doing it for 30 plus. However, there's fewer market crashes that the one that's done it for just 7 or 8 years has been tested by versus the one that's done it for decades. Because I'm still looking back at how did things perform when the market absolutely fell apart. Recessions are one thing, market corrections are one thing. Mediocre companies can get through those types of problems and come out on the other end okay. But for major ones, multiple major market crashes, there's just a lot of companies that can really get wiped out, cut their payouts, and take years to recover. So the track record is the main thing that I'm looking for. I'm also paying very close attention to the payout ratio because if a company starts paying out too much money in dividends to the point where they can't put it into other avenues of the business, they can't put it into growth, paying off debt, maybe doing share buybacks, all these different things that a company can do with their money besides paying out dividends. If that payout ratio gets too high, that becomes a pretty major red flag for me also. So I do pay pretty close attention to that metric as well. But it's how long have they done it and what's their dividend growth rate? Because that's the other thing. There's some great stocks out there that have grown their dividends for decades upon decades, and then you look at their dividend growth rate and it's like 1%, which, hey, if you're yielding 7 or 8%, a 1% growth rate's not bad. But if you're yielding 2% and you've got a 1 or 2% growth rate, I kind of don't care if you've been growing your dividend for 50 or 60 years. If I'm trying to live off of my dividend income, I need a better combination of starting yield and growth rate than that. So, once you start factoring in timeline, growth rate, market cap, narrowing down the list from 250-ish stocks down to 60 wasn't as difficult as you might think.
I want to start to talk about some ranges with these numbers. So what's a good dividend growth rate range? And also, I'd love to get a yield range from you. What are some of the yield ranges that you target? Is it a 0.5%, maybe to 1.5 or 3? Whereabout do you fall in those ranges?
Well, for me, there's kind of 4 different categories. So I broke my channel, my 60 stocks, into 4 separate tiers. Tier 1 is age 18 to age 30. Starting yield, I'm looking at getting, on average, maybe 1 to 1.5%, but I want that growth rate to be well above 10%, hopefully 12 to 14 cumulatively. And then for tier 2, age 31 to 41, we're looking more at starting yield in the 2 to 3% range for the most part, with a 8 to 10% annual growth rate, again, cumulatively. So it might not just be one single stock, but the whole group of them combined. Tier 3, age 42 to 53, 3 to 4% starting yield, 5 to 7, 8% year-over-year growth. And then finally, tier 4, 54 and older. I'd really like to get at least a 5% starting yield, and I certainly still want to see year-over-year growth of about 3 to 4%, just so when I'm not reinvesting those dividends in a quote-unquote normal year of inflation, my yield is still going to keep up with the rising cost of living. So those are kind of the ranges, but if you add the starting yield and the expected dividend growth rate together, then you'll notice on all of those, I'm still looking to get at least 9%, if not higher, adding those two together. So I want that, regardless of whether I'm starting with high yield, low growth, or low yield, high growth, I want that growth rate combo factor to be 10% or better across the board.
Now, your portfolio, 60 holdings, and again, not inclusive of the ETFs, was similar to mine actually a few years ago. And essentially during COVID is when I really went shopping and loaded up on a lot of positions. Who couldn't? They were all discounted.
Yeah.
And about, I don't know, maybe it was just about into 2021, I heard a Bill Ackman speech, or he was in an interview, and he shared basically less is more. And so I really thought about that. You know what? I cut down my portfolio immediately. I'm still in the process of trimming. I'm really now close to a goal that I have for 7 to 10 holdings. Now that in of itself is a bit riskier. You could still be diversified, but definitely you're going to get some more volatile swings in there. I'd love to get your take on the ideal portfolio size, how you're managing with 60 positions, if it's something that you think the masses of us should be doing, or is less really more?
So 60 is probably too many. I'm a nerd, and I don't have any problem keeping track of all that stuff on a spreadsheet and looking to see who's beating earnings and who's not, and looking to see who's growing their dividend and by how much. I mean, for me, it's fun. It's as much of a hobby for me to go through and crunch those numbers and see all those different positions. For most people, 60 is way too many. It absolutely is. And that's why I took my 4-tiered approach, because I thought, well, 60 is too many for most people to track. But if you've got 2 to 4 ETFs that are age appropriate for your time horizon, and then you're focusing on somewhere between 10 and 15 individual stocks that you would be actively keeping track of and adding money to when they look like they're cheap. I think that's a pretty reasonable amount of positions for somebody to keep track of. Now, for me, when I graduate, so to speak, from tier 2 to tier 3 next year, I'm not going to sell any of the stocks from tier 1 or tier 2. But I'm likely not going to continue to add any more money to them either. I'm just going to put them off to the side over here, let the dividends in those continue to reinvest, but I probably won't keep super close track of any of those companies and what they're doing outside of just, is their payout ratio staying under control, and are they still growing the dividend the way that I want? And that doesn't take a whole lot of time or energy to keep up with. But I'll really pay a lot closer attention to the stuff in tier 3 at that point, because I'm going to start getting some higher yield stuff, some stuff that's a little bit slower growing. But I would say that for most people, just to come back to the beginning of it, you probably want to have a few ETFs, 2, 3, maybe 4, and as far as individual positions and stocks that you're really keeping track of, I think about a dozen is a reasonable amount for somebody to sort of keep track of. And hey, if that feels like too much, then just go with about 4 ETFs, maybe 4 or 5. You get like I said, you've got some S&P 500, and then maybe there's some alternate things that you want to have too. Maybe you want to have something that's a little more dividend focused, like a VYM or an SCHD. Maybe you want to have a little bit of small cap exposure or some international market exposure. And that's probably about enough. And then how much you put into each one of those buckets is totally up to you. But whether it's individual stocks or ETFs, for me, the same strategy applies, because not all ETFs are created equal. Like I said, I'm focusing on VIG right now because I'm still just young enough that the 9 to 11% year over year dividend increases VIG should provide are going to be advantageous to me. But here in a few years, I'm going to be shifting more to SCHD, VYM, a little bit higher starting yield. The annual growth rate on the yield may not be quite as consistently high as VIG. There's going to be some SCHD heads out there that say like, no, SCHD beats all of them. Probably so, but they only have 100 stocks in them, so there's probably going to be a year or two here and there where SCHD underperforms in growth. But again, it's all about just time horizon and picking the correct things for your age and time horizon. And really with ETFs, I don't think you can go wrong with them unless you're just buying the wrong one for your age, if that makes sense. Like I like SPYD. It's a simple ETF, low expense ratio. It just holds the 80 highest yielding stocks in the S&P 500. Can't get much simpler than that. But I don't want to be buying SPYD right now in my early 40s because the dividend growth rate isn't high enough. The starting yield's pretty nice. When I hit age 54, 55, SPYD is probably going to become more of an emphasis for me because I'm just going to want the higher yielding, stable things that are big time market cap companies with high yield. But I would say, if you keep your positions at maybe around 20, I think just even the quote-unquote average person shouldn't have any trouble keeping track of that. If you're a nerd and you want to have a bunch of positions like me, go ahead. There's nothing wrong with a lot of diversification, but I wouldn't ever recommend buying an individual single stock unless it looked like it was trading cheap.
I'm really happy to hear you mention SCHD in the capacity you did, which was only in a few years from where you're at now, you're going to be shifting gears towards SCHD. And I just want to hone in on that because I feel like so many investors are getting excited by the yield and missing out on a lot of the growth. Now, when it comes to the most common mistake that you think investors are making, and maybe it's the yield chasing, but if you had to narrow in on just one mistake that you can share with us younger investors or even more, older investors with some experience but haven't quite dabbled in the areas that you have, what would that mistake be and how do we avoid it?
Well, let's take, for the younger investor, it's yield chasing. No doubt about it. Younger investor, it's yield chasing. And we've already kind of talked about that. It's exciting to get yield, and it's hard to wait on the year over year growth of the yield to really start taking effect. And I would say for an older investor, I think a lot of the times older investors sometimes make the mistake of selling out of things maybe a little bit too early. Because if you think about the profile of an older investor, they've got a nice portfolio of, lots of different positions, and it can be really tempting, I would imagine, if I'm putting myself in those shoes, to just sell out of something like, well, I take Microsoft for example. That's a low yielding stock, but if you're an older investor and you've got a lot of money in your portfolio, plenty of dividend income coming in, there's not necessarily a mistake that you can make, but you might sell out of something early and lose out on a lot of growth, or panic sell something because there's some bad headlines that come out. It's a great stock that's had a bad quarter, and you go jumping out of it at exactly the wrong time when everybody else is, as opposed to just sitting back and being patient and not messing with your portfolio, doing too much tinkering and too much guesswork with it, as opposed to trusting the positions that you spent years building up.
Colby, one of the stocks you mentioned earlier was Waste Management, and Waste Management happens to be a stock that I have now really been focusing on and watching, of course, for dividend growth. It's got a heck of a dividend growth rate. I want to know your take on Waste Management in the future of Waste Management, where you think it's heading, and similar stocks to Waste Management in terms of high dividend growth rates that really you think a lot of us are overlooking or haven't even seen.
Well, Waste Management, I believe, is going to continue to go up both in share price and in dividend growth at a nice steady 45-degree angle. They might have a bad quarter at some point in time and the stock will dip. It happens with every stock, and every once in a while it happens with Microsoft. However, think about what they do. We're talking about the largest trash collection and waste disposal company in the United States. It's not even close. So I don't care who wins this presidential election. I don't care what happens with foreign policy and all of the conflicts happening around the world. What happens with the Fed and the interest rate cuts, or do they cut them? Do they not? All of that stuff, when it comes to Waste Management, to me, is just a lot of noise. Because if you're living in a first world country, you better freaking hope somebody's going to come and pick up the trash every single week. And if they're not, we've probably got some very serious problems on our hands, to where it's not just Waste Management that's suffering in stock price appreciation. It's everything in the S&P 500. So for me, you look at something like trash collection. Is that sexy? Hell no, it's not. Is it absolutely crucial to our day-to-day living in a first world society? You better freaking believe that it is. So that's one of my absolute favorites. I'd say it's in my top 5 as far as just favorite stocks to own. If someone was going to buy a stock that looked quote unquote overvalued, that might be the one to go with, because again, it just does not matter what's going on. Doesn't matter who the president is or any of that stuff. They've just got, I wouldn't call it a monopoly, but they're the biggest one. They're the biggest one by market cap. They're going to do well in good times and in bad. And if they have a bad quarter at some point in time and their stock price dips, I'm going to be cartwheeling to my to my brokerage account to go throw money in there and put more money into Waste Management, because I just don't think that you can go wrong with that one. And there's some other ones too that kind of have different industries, but similar idea. Like, I would think that Lockheed Martin is going to do well in times of war, in times of peace. When your largest customer for your product is the United States government, you're probably going to do all right no matter what's going on in the world. And unfortunately, there's going to be conflict somewhere in the world for some reason all the time. It's just one of the depressing things about the human condition, I just have to say. And the United States, we're the big dogs in that, right? I mean, it just seems like we've got our fingers in just about every pot. So regardless of where that conflict is, there's probably going to be some money to be made in it for Lockheed Martin. So if you feel all right about investing in war, then that's going to be another one where I think the 45-degree angle up on that stock is going to be pretty consistent no matter what's going on. So those are a couple I can think of just right off the top of my head. And I'm always going to like McDonald's. That is a backdoor real estate play. So I mentioned earlier, REITs, your real estate investment trusts, don't have great tax advantages the way that a lot of other dividends do. You're going to get taxed at ordinary income rate with your real estate investment trusts. They have higher starting yields. They have to pay out a certain percentage of their profits to shareholders just by dint of the type of company that they are. McDonald's is not a real estate investment trust. But if anybody's watched The Founder, that great movie with Michael Keaton, or they've read the book, or they know anything about the way McDonald's operates, they are unique. They own all of the real estate that their restaurants are located on, and that's where a lot of the value of that company comes from. So when I invest in McDonald's, I am investing in U.S. real estate, as well as probably some international real estate as well, and I'm getting qualified dividends because they're technically considered a restaurant, not a REIT. So those are three that I'll always find a way to invest in some of those.
Now, Colby, do you pay attention at all to macroeconomic events? Do they matter for you? I mean, obviously, as a dividend investor, it's really like the buy and hold almost forever mentality. But do these macro, economic factors factor in for you at all? Interest rates, wars around the world, any of this factor in for you when you're making investment decisions?
Not at all. Not at all. I'm interested in all of that stuff. I love reading about politics and conflict and different things that are going on in different sectors. I mean, it's interesting reading. It's interesting stuff to listen to podcasts about and all of that stuff. But when it comes to my investing, no, not really. Not particularly. I think the only macro that I'm paying attention to is if there is a major market crash, or even just a market correction. Let's just say the S&P 500 dips 10% over the next 60 days. Let's just say it happens, right? The only way that that's impacting my investing is it just means I'm working more hours. I want to make even more money. I'm going to side hustle harder because I want to put even more money into the market when that's going on, because eventually it's going to come out of its slump, and I'll have even more at the end of the day after that. Fortunes are made in market crashes.
Colby, I got the last question here for you. It's the loaded question that I'm sure you're well aware of what it is, but I'm going to toss you $10,000 to invest in any individual stock or ETF, your choice. I'd love to know which stock that would be and the why behind it.
Sure. So for me personally, if it had to go into a single stock, I'm going to stick to my tiers. So I'm going to go to my spreadsheet, look at my tier 2 stocks, which is the age range I'm in, 31 to 41, and I'm going to see which one is the most undervalued by my metrics, which I'm looking at what is the current day yield versus the 4-year average yield. Very similar to what a website like Simply Safe Dividends is looking at. I sort of just reverse engineered that for myself. And right now that would be Hershey. I think the Hershey company is very undervalued right now. I have been adding personally to my Hershey position for the last 3 months at least, maybe a little bit more. Hershey, in my estimation, is starting to push 50% undervalued. Most of that, from what I can tell, is because for whatever reason, cocoa prices are expensive right now. I don't think cocoa prices will be expensive forever. And I waited for years before I started investing any serious money in Hershey because the stinking thing was always overvalued. But this year it's not. So if it was a single stock right now, stick into my tier. I'm going to put that into Hershey. And if I were to put it into a single ETF, I'd put it into VIG right now. And again, that's just
Investors.
because of my age and time horizon, not because I think VIG is the best ETF in the world. But I think for where I'm at right now, that would be a good place to put it.
We have a first for everything. This is the first time we had a Hershey stock pick. So I'm excited to take a look at Hershey, hopefully with our fellow viewers who are out there. Now, investors, you have to head right on over to the DGI Crabs YouTube channel there with Colby, a brand new channel, but a channel packed with insights. If you're looking for dividend stock ideas, definitely jump over to Colby's channel. Let him know what you think of it. Join his community. Colby, it was certainly an honor and a privilege to have you here on Masters of the Market, from a viewer now to a guest. And until the next time, investors, we will see you all there.